Hello, and welcome to the HBS Club of San Diego webinar. My name is Edward Hughes. I'm the president of the HBS Club, and we're delighted for you to join us today. I want to thank our sponsors, City National Bank, Latham Watkins, Dowling Yankee, KPMG, Hughes Marino, and the Honor Foundation. As you can see, our mission is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. So we do this for a number of things. We have been, since for the last year, basically switched over to virtual programming because obviously with the pandemic. So we're hoping that everybody is safe and well. Obviously, we're not through this yet. And there's, the healthcare crisis continues. Some of the economic damage is obviously continuing. And what we're going to have today is a very interesting discussion on assessing the damage of COVID-19 on the commercial office market. And the worst is yet to come. So our mission as a club, as I say, is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. And we do that by holding forums like this, which are now virtual, where we talk about topics that we think are going to be interesting to business leaders. We do that through management development programs where we educate people in San Diego with some of the HBS case studies and the HBS case study method. And we have a strong passion for supporting nonprofits here in San Diego as part of a social enterprise initiative. And over the last decade or so, we've had the opportunity to really invest quite heavily in making San Diego a great place to live and work by supporting these nonprofits, not only in management education, which you can see the dollars invested in the red columns here, but also in cash donations as well. And certainly through this pandemic, supporting those nonprofits has been a big push for the club and something we believe in. So let me go back and give you a little bit of a history of some of the programming we've done over the last year. You'll see in June, we actually started with David Marino and John Jarvis, who are going to be joining us again today, to give us an update on what's happening in the real estate market. Back in June, they had, they got obviously 3-4 months into the pandemic, and they thought this was going to be ugly. So I'm looking forward to hearing today what the real world and the battlefield actually looks like. In July, we had Bill Doyle, the executive chairman of Novacure. We had a HBS professor, legend Bill Salmon, entrepreneurial finance. Bill Ackman, billionaire investor from Pershing Square. We were going to have Professor Francis Wright. That's got postponed. We're still hoping we're going to be able to do that shortly. We had the Global HBS Networking Night. We had Kevin Sneeder, the global managing partner from McKinsey and Company. Robert Engel, Nobel laureate, talking about the economics and what's going on, obviously, with some of the stimulus initiatives that took place right around the election timeframe, which was very interesting. And then just a week or so ago, we had Laurie Hearn, CEO of iNewsSource, talking about fake news and how to spot it, and how you can help protect yourself from that, and some of the things that were going on there. So, and then today we have David Marino and John Jarvis from Hughes Marino. So for the program today, the logistics are very straightforward. They're going to give us a quick presentation talking about some of the changes that are happening in the marketplace. Then we're going to do a question and answer. So please type any questions into the question box, and we'll try and address as many of those as possible. This webinar will be recorded. It's going to be available to our members immediately after this, because some people may not be able to make this session on time. And then in 30 days, we'll publish this on YouTube. So let me stop sharing the screen here and introduce our guests today. So, these are people hopefully you're familiar with. David Marino is a co-founder of Hughes Marino, one of the nation's leading tenant representation firms. He's had 30 years of insight in the commercial tenant space, over 2,000 leases, 20 million square feet. John Jarvis is his colleague, a senior vice president of Hughes Marino, 34 years in the commercial real estate, and one of the founding brokers of Hughes Marino. These gentlemen have been very busy, and we're looking to hear what's going on in this commercial real estate marketplace, because obviously I think it's been 7-8 months since we saw you guys, and you're right there fighting it every day. So give us a story, David. Turn over to you.
Thanks, Edward. So for those of you who don't know who we are, I think it's worth just a minute to explain the lens that we see the world through. So we are a commercial real estate services firm that does only represent tenants and also owner user buyers like WD-40. We represented them in buying their headquarters. but primarily 98% of our client engagements are representing tenants either renewing, downsizing, subleasing, relocating, and doing some kind of lease transaction activity. And so in any given time as a firm, we now have offices up and down the West Coast, and recently last month expanded into Denver. John, in fact, is wearing our Denver kickoff t-shirt. We like to do swag for each of our new offices. But we're working with over 1,000 companies at any given moment in time, but talking to thousands more about what's happening with their future plans. And so we call this the no spin zone. This is really what's happening on the streets, and not what we wish the market was going to be, but what it really is from a tenant user perspective of real estate. And back in June, we were sort of surveying the battlefield. Things were a total disaster in the economy, and the capital markets were just recovering. Tremendous uncertainty as to the pandemic and work from home, and we saw the early indicators of the market really going badly. We saw tenants defaulting on their leases. We saw the surge of tenants subleasing space. We saw really chaos in the market. And let me just start with the good news. So the good news is threefold. One is as it relates to non-hospitality and non-retail tenants, most tenants are still in the fight. In other words, most companies are still in business. They may be working remotely, they may be downsized, but most of our clients are still in business. And I think that's really promising for the future. The second is the surge of investment, the billions of dollars that have been raised in life science, not only COVID, but other therapeutic and pharmaceutical activities in town, has created tremendous surges of employment, as well as the biotech industry taking over 1 million square feet of space off the market in the last year. That was unexpected. The third good news is what's happened in the industrial sector. Industrial companies have been blowing up. Amazon is the poster child for this. Amazon has leased over 150 million square feet of industrial space since April of last year during the pandemic. And about 1.5 million of that is right here in San Diego. They've leased about half a dozen buildings from as small as 100,000 to as big as 500,000 square feet in Poway as they build out their last mile infrastructure. So we've actually, during the pandemic, seen industrial vacancy and availability rates go down, and actual upward pressure on industrial rents, which has really been a surprise. It's the first time in my 31-year career, and now my fourth recession, where I've seen a decoupling of the office sector from the industrial sector. Typically, they rose and fell together. This time, they're inverse to each other as industrial and life science real estate outperforms office space. So what we've seen during the pandemic is those are the bright spots. But we really are going to center this conversation more around office space. What's happened first of all, broadly around the country in the major office markets, and then we're going to narrow in on what's happening here in San Diego. So there's a couple of trends that have occurred nationally. The first is that tenants that have had leases expiring since the pandemic started, particularly smaller tenants below 10,000 square feet, have more often than not relinquished their office space. So as a tenant had a lease expiring the end of last year, or maybe even March of this year, because those small to medium-sized businesses are working remote, they're not using their space, they've let the lease expire, they haven't renewed, and they haven't moved and taken a smaller space elsewhere. So that's trend number one, and that has caused tremendous inventory of space to come on the market as available. The second thing that's occurred is bigger companies with longer term leases, typically 3 years or longer, that have come to the realization they're never going to reoccupy to the extent they did pre-COVID, and they have more space they need, have put that inventory on the market for sublease. And so we've seen a surge of office sublease inventory really around the country. The worst example of this is San Francisco, where now there's about 9.3 million square feet of office space on the market for sublease. So literally half of the availability of office space in San Francisco is sublease inventory. And so, and this is something that has also occurred in Boston, in Dallas, in Denver. We've not seen the extent of sublease inventory in San Diego, but it's come on more kind of dribs and drabs. But I want to sort of share my screen here and give a national snapshot of what's kind of going on in the markets. So this slide sort of shows you the major markets, and this looks at vacancy rates. And what I want to do is sort of talk for a minute about vacancy rates and availability rates. So vacancy rates, as to use a Wayne Gretzky analogy, is where the puck is. Availability rates is where the puck is going. Okay, so as you look at the major markets around the country, no surprise to everyone here, vacancy rates have been screaming off the chart in most major markets to the north. So New York City, 21% increase since COVID. San Francisco, 78% increase since COVID. Seattle, 32. Most markets are in the 20s, 30s. But here's what's really damning for what's coming in the market is when you add in you look at the availability, and the availability is all space on the market, not just space on the market that's vacant. And the distinction I like to use is if you and your partner, your spouse were looking to buy a home, you wouldn't say to your broker, show me the vacant homes for sale. You would say, show me all the homes for sale that meet my requirements, even if someone's currently living in the house. Well, that's the same with vacancy versus availability. Availability is all the space on the market for lease or sublease. So it captures the sublease inventory. It also captures the inventory of space where a tenant has told a landlord they're not renewing, and to put the space on the market for lease available April or June of this year. The space isn't counted as vacant, but it is available. And so there is a major disconnection between availability rates and vacancy rates. And this is where it's really, really dangerous for landlords now. If you look at the column on the red, that is the percent differential between vacancy and availability, where availability is higher than vacancy. So in the case of New York, for example, which was the first market, the availability rate is actually 49% higher than the vacancy rate. What that means is when you count up all the sublease inventory and all the space that's on the market for lease by landlords, but that isn't technically yet vacant, there is a massive understating of the supply of space on the market when you only measure vacancy. These numbers are staggering. When you look at 30, 40, 50% differentials between availability and vacancy, what that tells you is that there is a massive supply in the funnel of available space that tenants can consider for lease or sublease, but that landlords and the brokerage community aren't counting. And these numbers are all up and to the right in the last 3 quarters, since the end of Q1 of last year to basically year to date, 2 weeks into Q1. So less than a full year, it's basically 10 months of measurement. So, and if you start annualizing these things, if you realize that COVID is here to stay for another, 6 months, maybe through the rest of the year before corporate America kind of comes back to the office and puts the pieces back together and figures out how much they really need, another 20% of leases are going to expire this year nationally. And as those leases expire, more and more tenants are going to come to the conclusion that they don't need as much space as they had, or they're not going to renew those leases at all for those that expire in the first half of the year. So we're going in some major headwinds for the office markets nationally, where we believe that as you look at these market availability rates, if you look at, say, let's take, Boston and Philly, and some of these are in the mid-teens. Some availability rates are already 25%, like Houston, where I'm doing a 6-year lease for a client that has a year of free rent. I'm going to move. I just realized I need to shift gears from the room I'm in to a different one, because we just had our water softener system implode on us.
While you're moving, David, I'll chime in here. Something that I think would be useful for folks to realize, maybe people get this, but office leasing and the office market generally has this equivalent of a Mendoza line. And when you're talking about vacancy rates, generally it's about a 10% vacancy rate that represents the tipping point from a landlord's market to a tenant's market. With vacancy rates at 10% or above, we generally see rents declining. With vacancy rates at 10% or below, we generally see rental rates increasing. And I love your analogy that the availability rate is what's coming through the pipeline. So that's going to end up in the vacancy rate. You can see we're clearly going to continue into this market with a trend towards increasing declining rents.
Yeah, and the problem is, as more and more tenants' leases expire, and we believe that this is a trend that we're now into for the next 2 to 3 years as corporate America downsizes, right sizes, given that 10 to 20% of all employees seem to want to work remote, full-time or part-time post-COVID, and the employers seem willing and wanting to let them do that. That's a direct pass-through to what's coming for landlords. Like every tenant is going to need 10 to 20% less space. And so as this negative net absorption starts flowing through the national office markets, you're going to see tremendous, really downward pressure on rents. Let's talk about what's happening in San Diego. And I'm just going to kind of work north to south on some of the major office markets. So these are 3-year trend lines on what's happened in some of these markets. So here's Carlsbad. The orange line represents availability rate. The blue line represents vacancy. And the more correlated those are, the closely tied together they are, the stronger the market. So you see that Carlsbad actually started last year in pretty good alignment where availability and vacancy were almost tied together. But in the last 4 quarters, there's been this just radical departure between what's vacant and what's available, with availability rates now up and to the right to 21% and going north from there. Del Mar Heights, a little bit of a similar scenario where you see this radical spike in availability rates up and to the right in Del Mar Heights, now up into the mid-20s. You see UTC has a similar phenomena. Just over a year ago, UTC was really one of the tightest markets in Southern California and is now ending last year, coming into this year at 16% availability, with vacancy also trending upwards. And last one is downtown, which has been sick for a number of years as new supply comes on downtown and tenants look to leave high rises and find the conditions of the homeless situation and the cost and availability of parking downtown something that they don't want to be dealing with. But again, availability rates going up into the high 20s and probably end the year up into the 30s. So what's going on in San Diego County is similar to what's really happening on a national trend, where you see tenants vacating office space, putting it on the market for sublease, telling the landlords that they aren't going to renew, and when they are looking to relocate, coming back smaller. And that's sort of what we're dealing with now. Now that we're going into 2021 lease expirations, most of our clients who are transacting here in this calendar year are getting smaller. So we're representing a 50,000 square foot financial services company in the Del Mar Heights market that is now looking broadly, including UTC, and they're looking at 20,000 square feet. So literally, because of either layoffs or remote working, going to wind up coming back at 40% of the size they were pre-COVID. Most office tenants we're working with right now throughout San Diego County are planning to occupy anywhere from 60 to 80% of their pre-COVID size. And so, just put your imagination to work here now. Think as a lease at a time, right? Week after week, month after month, as the year goes on, as tenants downsize one at a time across the county, across the country, across square footage ranges, the negative net absorption effect of this, meaning the net space coming on the market as a result of this resizing, is really the fatal blow that's coming to landlords. And they're all now just starting to get their head around this. And I'll give you a real-time example. This is something that just has come up in the last 30 days. We represent a full floor law firm in UTC, and they're in the American Assets building, which is the really beautiful tower over by the 805 freeway just north of La Jolla Village Drive. And their lease expires next January. And so we wanted to get kind of a start on the market. We wanted to get ahead of it. And we got a pretty crummy proposal from the landlord at a $5 rent to renew. So we went into play, put our process to work, came to terms with the Irvine company, ultimately to relocate. Now, this is space that's going to be vacant in Executive Square, a full floor that Irvine company has a tenant moving out of this summer. And so they want to try to grab this law firm and pre-lease the space. So we signed a letter of intent last week, and this is a building with an asking rent of $360 a foot. We signed a letter of intent at $310 full service gross with 6 months free on a 9-year deal. Okay, and that's it. This is a lease that doesn't even start until February of next year. Okay, and we got a huge tenant improvement concession package and a moving allowance. So we signed the letter of intent, and the current landlord came back and said, we got a new deal for you. We'll give you 5 months free on a 5-year lease. But what we're going to do is we're going to write off part of the space. And even though you're in 24,000 square feet, we're going to call the square footage 16,700 square feet. So for the whole 5 years. Okay. So we occupy 24,000 square feet, but get this, we only pay on 16,700, which is a 32% discount to market. And in addition to that, we get 5 months free, which is another 8% discount to market. So basically, you pay our face rate, right? You pay our $5, but we get a 40% discount through the concessions that no one is ever going to see. Okay, so what's happening is the appearance is, if you don't know what's happening in the trenches of commercial real estate today, it would appear that asking rents are unchanged. And this landlord is going to say they'd signed a $5 deal. And all those things are true. Okay, but when you look at the effective rent, when you look at the concessions that are given today, the market has melted down worse already than we said it would in June. You know, back in June, when we did this presentation, Edward, we said the market would be down 20% by the end of 2020. Well, it's there and past there. Okay, I mean, you know, this again is a transaction doesn't start until Q1 of next year. That's 40% off pre-COVID. Okay, so this is the kind of market where if you have a lease and you think you might want to renew, you would be a silly fool to engage the landlord in a conversation about renewing in a vacuum without going to market, without really understanding what your value is and what the market is. And I could not have told you 2 months ago that this is how it would end with this law firm. But with the right process, going through a due diligence exercise to validate the market and understand today what the market is literally changing that fast. The market today isn't what it was 30 days ago. And so this is a falling knife for landlords. We don't know where it's going to end, but it does end really, really badly for office building landlords. Again, for tenants that put into place the right process, you have capable representation, and you get on the right critical path, and you look at real valid options to relocate. We just had another situation, and this is a client headquartered here that has a good sized office in Houston. We literally were going to relocate from 13,000 square feet to 11,000 square feet. We signed a letter of intent. We're in lease negotiations, and the current landlord comes back and says, what do I have to do to keep you? And I explained that we had a year free on a 6-year deal. So the current landlord in 2 days dusts off their proposal, changes it from 3 months free to 12 months free, and $5 in TI to $20 in TI in 2 days. But we had to be negotiating a lease somewhere else for the current landlord to get there. And I think that is the difference now versus what we've experienced in the last decade. I mean, I saw this kind of behavior back in the 08-09 financial crisis and back in the tech wreck of 2000, but we are back in that kind of real estate recession where you have to really, you have to fight the fight. You have to do the work. You have to go to market. You can't just take a landlord's word at what their best and final proposal is, because unless you prepare and get after it and get out and get real bona fide offers and really do the work to negotiate, you're just never going to get to whatever that bottom line really is.
So let me chime in here, because I think it's really interesting to think about how this is going to play out and to realize that it takes time for all of this to be realized. As you've described, we need time for leases to roll so that they can get repriced and reset to market. If you look back to the financial crisis, it actually took 3 years for the losses to peak, the bank losses to peak, following the formal end of that recession in June of 2009. There's that trailing lag of sort of suffering in the marketplace. So if it's going to take 3 years to catch up, that's still yet to play out in the current cycle with the same kind of a trailing lag. And speaking of the landlord, so here's what I want to talk about. I want to talk about how dicey things are going to get for landlords, because it's not just about these declining rents. I think we're going to start seeing increasing cap rates, which means declining property valuations. So let's just talk through that math a little bit, right? For the sake of argument, let's say that rents are ultimately, we're going to see maybe a 30% decline in rents as a result of this pandemic. Okay, that sounds pretty bad. I've got some stats that I could back that up. We have to wait to see how that plays out, but let's assume 30%. And as bad as that sounds, it's going to be worse for the landlords. And here's why. If cap rates move, for example, from 5% to 6%, on top of that 30% drop in rents, then the net effect of the property value will be a decline of 42%. Okay, if you've got a 70% loan on your property, you're now underwater. And what's worse, if the cap rates move from 5% to 7%, then that 30% decline in rents will correspond with a 50% drop in property value. So they may not be saying it out loud right now. Landlords are nervous, and they should be.
Yeah. And I think also landlords have yet to see tenants really come back. I know that landlords have been monitoring their parking cards. So for those tenants that have high-rise or mid-rise buildings where you use a parking card to enter the garage, landlords are tracking to what extent tenants are coming back and finding that it's pretty much flatlined around 20%, and it's been bumping around. So landlords have sort of gotten past the delusion that, oh yeah, everybody's just going to come back overnight, and once the vaccine comes out and the confidence is higher, it's going to change. It's really changing slowly. And to John's point, I was here in the early 90s during that real estate recession, and the bottom of the market really started imploding, the commercial real estate market and the economy in San Diego in 1990, 1991. But the commercial real estate market didn't hit bottom until 1995. It took 4 to 5 years to get to the actual bottom. And so this is just a massive asset class. Commercial real estate is such a big, slow moving asset class. It's not like the capital markets where there's this, day to day or even quarter to quarter volatility. Once it starts going in a new trajectory, which it is, it starts going down, and it takes a while to find some kind of new equilibrium. Well, that new equilibrium is, economics 101, right? It's going to be supply and demand driven. If demand continues to be anemic and supply continues to increase by corporate America shedding space, well, it just ends really badly. And that's sadly where we're going in this. And if you were to ask me, where does this end for a lot of building owners? Those folks that have, as John mentioned, 70% leverage or more on their office buildings are probably not going to be the owners of those office buildings in 2 or 3 years. They're going to inevitably either get wiped out by their lender through foreclosure or some other means. But this is going to be a tragic, sad ending for a lot of office building landlords across the country. And there are folks that don't have a lot of debt. The big REITs like Kilroy Realty and American Assets are much more healed, as are the Irvine Company. And so, we think in San Diego we'll have more stability around the office asset class and more resilience around foreclosures than potentially there will be in other communities. But you're still going to see some tough times here in the next 3 to 5 years in San Diego.
I think it's worth mentioning, Dave, you and I had an interesting conversation. We're looking at the data, and we feel as though San Diego is not as hard hit, for example, as San Francisco, which is going to be out front with the declines. And the question came up, okay, so why is that, right? Let's think about why maybe we're not as hard hit as a San Francisco. And my theory is that San Francisco, the center of their economic engine is their downtown market. And in San Diego, that's not the case. I think over the entire course of my career, certainly the last 20 years, we've consistently seen this migration to the suburbs from downtown San Diego. And downtown San Diego is not the hub engine of our local economy. With the tech that's moved to the suburbs and getting out of, other than law firms who need to be at court almost daily, being downtown it's not the hub of our activity. So as a result, what we're seeing in San Francisco is a flight from the urban center to suburbs and markets that aren't high-rise stacked. Well, we've already gone through that. We've been going through that for a long time. It's why that one slide you had for the downtown vacancy and availability, it didn't show a market change. It's been, climbing the vacancy rates up and to the right for almost my entire career.
Yeah, downtown's never been strong, unfortunately.
But that means that we're not likely to be the hardest hit of the market. So if we got a little good news for the audience, and we're not just all doom and gloomers.
Edward, what kind of questions do you have, or has anything come from the participants on the chat?
So I've got a few questions, and then the participants, if you want to kind of start typing them in, that'd be great. So when we met last in June, obviously it was unclear exactly what demand change would happen, whether this is going to be temporary or not. And now what I'm hearing you saying is that most companies are looking at a 20% reduction in kind of, requirement for office space. So obviously that's going to filter through the marketplace. And now you're saying, okay, that is showing up as, potentially 30 to 40% decrease in rates. So that's kind of a worse situation than I think you were thinking back in June. And you're saying this is getting worse. So what are you advising your tenants to do?
Well, that's a great question. So I can tell you advice I've given in the last week. I had a conference call this morning with a Sorrento client that's got 40,000 square feet that thinks they'll only need 25. Their lease expires April of next year. And normally, pre-COVID, you would want to get going, a year to a year and a half before that. What we advised them is, we shouldn't be doing anything right now. We should wait until Q2. The market is getting softer. By the time, we get active, you're going to be one of the bigger tenants in the market and with strong credit. And we just want to, let some time burn off our current lease and not get into the market too early. So I think that's one of the pieces of advice I have is, and your head would spin on the number of options you have. Like if you're a 3,000 to 5,000 square foot tenant today in Carlsbad, you have literally like 80 choices. Or if you're in Del Mar Heights today and you need between 3,000 to 5,000 square feet, you have 55 choices. Okay, so there's been a flood, particularly of small space below 10,000 square feet, a flood of inventory come to market in the last year. And so the longer you wait, the better deal you're going to get. And so you don't want to rush to market. That's number one. You want to let time burn off. And you can, pre-COVID, most tenants were confronted with supply shortages and often situations where you had to do a lot of renovations. So you needed 7 or 8 months to pull a permit and design the space and do the construction. Well, now this flood of space is space that was built out 2 to 5 years ago. And it's in great condition. And a lot of it is furnished that's on the market for sublease. And so you don't need the kind of lead times that you had pre-COVID. You can get out into the market 3 or 4 months before your lease expires if you're a smaller tenant below 10,000 square feet and still find great space and great deals. The other thing, I would advise is don't go long unless you get a hell of a deal. This market is probably 3 years away from bottoming out. There's an argument for doing 2 to 3 year leases, but if you've got strong credit and you can make a large commitment on a longer term lease, you better get paid for it, which is kind of the example of that law firm that I gave that was going to sign a 9-year lease, and we just had a heck of a deal. So your concessions should be massive if you're signing a long-term lease, because you've got to consider that you're potentially leaving money on the table by going long in a market that's deteriorating short term. So this is the kind of market where I think most tenants are going to be doing 2-3 year subleases or direct leases, and bigger, stronger long-term leases are going to be left for great credit.
And at the risk of being self-serving, I think it bears stating that one of the reasons we're so busy in this moment is that we're in a really unique position to shift into a mode almost as an investment banker, like a market maker. Like the old market was all about comps and what's the market rent, and here we are, and there are no comps and nobody knows, and we want to be forward looking. And because we don't represent landlords, look, we do this with compassion and empathy. The landlords are in a brutal spot, so we're not jumping on the table, and we're not an 800-pound gorilla. But the truth is, we're in a unique position to be able to take the landlords where they don't want to go, and that's what we do. That's price discovery, competitive negotiation, and it's really, really hard for the traditional agents to do that. It's why these great teams in these other markets are saying, I think I need to get off this landlord platform and go be a part of this Hughes Marino train ride, because these guys are in a position to actually direct the market and find the new market.
Okay. Edward, can I answer a few of the questions that have come in on the chat?
Sure.
There's one here from Jonathan, scratching his head. Why is Horton Plaza still underway and Navy Broadway? Well, Navy Broadway is being repositioned as a life science campus downtown by Alan Gold and his investment group, and we wish him well. We hope he's successful because there's no real office purpose for it. And then Horton Plaza, just the problem with these real estate development projects is they're multi-year projects, right? They own it, it's financed, they're underway, they got entitlements, and they're very, very pregnant, right? They got to move forward with birthing that baby. And it's just they can't pivot, unfortunately. But they've also broadcasted that they will now consider life science for their project. So that's the tough thing about being a multi-year real estate developer, is you can catch yourself in a downward market. Kent Johnson,
can I take the next one?
Yeah, go for it.
Let me pull it back up so I can read it. But this question about how much does the shaky market show up in the public REIT valuations? So REIT share prices are down just over 30% through end of November 2020. That's according to the National Association of Real Estate Investment Trusts. Pretty compelling, interesting stat.
Yep, and some are actually outperforming others, right? If you look at industrial REITs and life science REIT, go look at Alexandria Realty stock. These industrial and life science REITs are doing well, and the office REITs are doing very poorly.
Well, and when you look at the broad category, like I described it, it's a little misleading because hospitality is thrown in that, and it's a massive loss leader and brings down the average significantly.
Yep, and Janie DeSells, hope you're well. Happy New Year. Asks, what's going on with retail, and retail in some areas are faring worse than others. So in urban areas like San Francisco, downtown Los Angeles, New York City, it's been reported that as many as 80% of the tenants are in default of their lease. And, you're seeing retail storefronts being boarded up all over town. I saw some pictures of downtown Minneapolis that are just chilling. Downtown Seattle is another area that's got a lot of problems. But I don't know how to answer that question. It's tough when you talk about retail storefronts. I just think, that was, retail was sort of 1 foot in the grave before COVID with what was happening online, and now it's, fully in the casket. So, and difficult to understand how retail would be repurposed. A lot of people are asking about repurposing office buildings, but the difficulty is that the floor plate configuration and the utilities and the parking for office buildings don't make them easily convertible to residential. So it's going to be tough. Someone asked, I would issue a whiplash effect that we're seeing for landlords. Is all construction ground to a halt? Yeah, it pretty much has. Unless something was underway pre-COVID and now finishing. But yeah, there's most forecasts for any new office construction are, that it's pretty much dead. I was going to say, I don't know if in the next decade we're going to ever need to see another office building, to be honest with you, built. I mean, the supply problem is that severe. Edward, did you have another question?
I was going to say, last time you basically said that you don't think there's going to be any office buildings being built. So obviously that's kind of coming to fruition. Let me go back to something you said that, if the landlord's got leverage on the facility and you want to negotiate hard and you're trying to get tenant improvement, do they have the capital to pay for the tenant improvement?
Some do, some don't. And we're valuing the concessions we can get. It might be that in lieu of tenant improvements, that the landlord would be in a position to give more rent abatement. But what you're alluding to is a very, very difficult dilemma for building owners. Is as the market goes down and concessions go up, some landlords simply won't be able to compete because they'll be in a situation with their lender that they can't go below a certain rent and they don't have any capital to fund these costs. In fact, I've got a situation right now with a law firm in La Jolla where we had negotiated and signed a letter of intent, and now the landlord can't deliver on it because they can't get lender approval. And so my client, being a law firm, is just, wants to sue them and, is losing their mind over this. But these are the kind of problems you encounter in a falling market like this. Is a landlord saying, well, here's your deal to stay, or here's your deal to move, but I got to get lender consent, and may not be able to get it or get it timely. And I think this argues for picking your landlord wisely. This is why having a landlord like Kilroy or American Assets or Irvine Company, institutional grade landlords are going to kind of be more able to weather the storm and win market share and retain tenants than your mom and pop or regional building owners might be able to.
And just to add insult to injury, if you think about these institutional owners who have leverage, these loans aren't 20 and 30-year loans. They're coming up, they need to be renewed, and they need to go back into the market to find debt to take out the existing loan. Okay, so let's start paying attention to the 10-year treasury, right? That's the rate on which mortgage rates are typically based. And it was 0.49% or something like this back in March. And as of yesterday, it's 1.11%. And a number of people are predicting it's going to be 2% by summer. So if the interest rates are starting to move, that is just more bad news for landlords trying to figure out how to navigate this storm.
I think, David, one of your other predictions last time was that you said, watch the Irvine Company. If they break ranks and start dropping prices, it's going to bring everybody down. So in the little analogy or story you gave us, you had a tenant that was negotiating with the Irvine Company. So have they broken ranks and they're basically dropping prices, and so everyone's having to follow suit?
So here's what's crazy. They haven't lowered their face rate asking rates yet. And this is a phenomena that's not just here in San Diego, it's pretty much nationally. If you talk to a traditional broker and they say, what's happening with rents around the country? And they would say, well, they're down a little bit, but they haven't really changed much. Well, it's like, the advertised sticker price for a product and then what it's really market clearing price is, right? The market clearing price of these things is 20, 30, 40% below the landlord's asking prices, which haven't been adjusted. So that law firm that I mentioned where we had a 310 deal, that's a 360 asking price. So what we negotiated was 50 cents a foot below ask. Okay, but they haven't lowered asking rates yet. And part of it is they want to take advantage of the inefficiency in our industry. Our industry is completely unregulated. The consumer, meaning the business owner or CEO or CFO that's going to sign a lease, is in a great information vacuum and has an incredible disadvantage at the negotiating table because they have no idea what the market really is. And so if I could share, have a real learning experience for everybody from this is you have to go to market and you have to be represented by somebody who's competent and really knows what's going on and is active in the market and is willing to push the envelope, because this is the kind of market where landlords are not going to soft serve it to you, and landlords brokers are more conflicted than ever because they're having to price support these owners on the way down. And so they can't go after these kind of economics because structurally they're married to the building owners. And so, it is the difference between the bid ask out there has a significant spread but you wouldn't know it looking at the pricing. It will change, Edward. I think the Irvine company will slowly start ratcheting asking rents down, and it'll happen this year, and then everybody will sort of be forced to kind of chasing it down.
If you're in an existing lease and you got some time left on it, how do you find out the financial health of your landlord? How do you know whether your building's leveraged or not?
So there are some public reports that we have access to where we can pull that information. So, you know, it's difficult as just a layman, you know, as a tenant to find that because you have to subscribe to some databases that we pay for. We have access to a lot of that.
Okay. All right, and we got a question from Tim Magnew. Do you anticipate seeing a conversion of office space to other uses, industrial or even residential, assuming zoning can be adjusted? Given the shortfall of residential units in California, I think that should be a priority of both landlords and state local government. John.
Well, I'll take a shot first, and then you can backfill Dave. Because I wanted to talk about this idea of the biotech market being so white hot, and it's just crazy, really. But I think it's another example of this K-shaped recovery that people have talked about generally in the economy, where, and in this context, what I mean is that office rents declining, lab rents increasing. I mean, the market is white hot with a lot of large requirements. And because of that spread, there are a lot of office building landlords saying, well, why don't I just build out some lab space in my office space and tap into that market that's white hot? But it's just not that easy. Some will do it, some will try. It's not that easy. And I would caution a biotech client to going into a building that's being converted by a landlord who maybe doesn't have the experience with life science clients. But pay attention to that spread, because as the K legs of the K separate, you know, it's an arbitrage opportunity that landlords are going to try and take advantage of. And I think Tim also asked about conversion to residential and retail to industrial, the big box retail to industrial. Yes, owners are going to try all of these things, whatever they have to try and stay alive. I would just say it's not that easy in the execution. These people drifting into what wasn't their primary lane, and it's a little bit fraught.
Yeah, there's some interesting examples of this, primarily in Sorrento and a few in UTC. So there's a couple of groups here in town. One is a group called Phase 3 Development that's actually backed by Harvard endowment money, and another group called Longfellow that's a sovereign wealth fund. Longfellow, during the pandemic, bought the 3 building office project where Force Point is, right off the Sorrento Valley Road exit off the 805 freeway, to convert those 3 buildings to life science. They also bought the 2 office buildings called Sorrento South Corporate Center, which is where the Rubio's is at the southwest corner of Scranton and Mira Mesa Boulevard. And they're now in escrow on the 3-building office project on the southeast corner of Oberlin and Mira Mesa Drive. And they are working with existing tenants to buy them out and terminate their leases. I'll give you a real-time example. So we represent a local company called Verimatrix. They got acquired by a French company pre-COVID. As a result, we put a 20,000 square foot space, 2-story office building on the corner of Oberlin and Mira Mesa on the market for sublease. We, as of today, have about $4 million remaining of lease liability. And we just came to terms last week with Longfellow to terminate the lease for $500,000, so that Longfellow can take the building back and convert it into life science space. So these kind of things are happening out there. But I think what's really difficult are the high rises in the CBD, where, again, as I mentioned, that because of a lot of fatal flaws of how they're built, either the floor plate configuration or dimensions or the parking or the utilities to the building, they're not designed to support residential uses. You know, for a residential use, you want a narrow rectangle so there's as much glass line per square foot on the floor as possible. Well, that's not how you build an office building. You build big squares or big rectangles that are 18 to 30,000 square feet. In some markets bigger. In New York City, you know, floor plates that are 50,000, 40,000 square feet. So these are not physically convertible to residential because they don't have enough window line, or because they don't have, you know, the fire sprinkler and the plumbing risers and the electricity and the mechanical So, I've heard a number of people say, why don't we just turn all the office buildings into residential and solve the homeless problem? It's like, well, it's just not how it all works. It's not how the capital markets work of owning these things, not how valuations work. So it's just the office market's just going to struggle for the next decade is what's going to happen.
And John, you'd mentioned in the preamble to this program that you're dealing with a number of companies that are getting rid of the headquarters. So, I mean, it's not just the 20% kind of downsizing. People are actually just going to permanently get rid of the headquarters, or at least for a while. So what's going on there?
Yeah, absolutely. Two tech firms that I'm working with that made the decision if they could be out of their real estate, they would prefer to be out of their real estate. We put 100,000 square feet for sublease, 75,000 square feet for sublease, and they just want to be done with it. And when we reemerge and return to the office, they will recalculate their space programming. What do they need in the new normal? And we'll go find it. But if we could be free of the existing obligations, they want just to be out of them. I think that's not an uncommon position. And I think a lot of companies have been slow to sort of transact on that, slow to act on that. I think more will start to say, especially now that we're not getting out of this as quickly as we hoped. When we met last June, we thought it was a 2020 problem. Now it turns out it's a 2021 problem as well. And so I think as this drags on, that more and more companies are going to realize they're going to have a different requirement coming out the other side of this. And if we could just be out of the current obligations altogether, they would like to be. That's what those clients of mine have decided.
Have you seen some well-capitalized tenants that are looking at this and saying, my landlord could be financially struggling here. Maybe if the cap rates are going up, et cetera, and low interest rates, maybe this is a good time to buy the building from them?
There have been, Edward, a surge of activity of owner user sales at almost near record high prices during COVID. So your point is spot on, but it's not as much about buying the building they're in, because the landlord they have isn't necessarily a willing seller. In their capital stack and their underwriting and their debt may be such that that's really just off the business plan that they signed up for. And so I haven't really seen examples of tenants buying the building they're in, but there are a lot of examples of tenants with leases expiring in the last year that have gone out and done owner user purchases, mostly smaller companies below 20,000 square feet.
Okay.
I also worry that I don't think the price declines are reflected in the current moment. And as we've alluded to, it's going to take some time for that to play out.
Yeah.
So we may see that over time. So
Yeah.
A related kind of timely topical question. There's one individual that's going to be leaving DC tomorrow and heading down to Florida, who owns a lot of real estate in New York. That is either in the hospitality space or is in kind of residential, and New York's kind of struggling. How does that play out? Oh, and it's pretty highly leveraged as well.
You're setting landmines for us. You really want to go there?
I don't think we can comment on Donald Trump's personal financial affairs in terms of his real estate. It's really not even known what real estate he actually owns and doesn't own.
I have heard that he's got 300 or 400 million in debt that he needs to roll over, and those increasing 10-year treasury numbers are probably a little bit alarming to someone like him.
I would imagine so. And he's obviously in high-rise buildings in New York, so that doesn't seem like the right place to be in the real estate market at this time, right? So,
tough place to be right now.
Yeah, tough place. All right, let me see if there's any other questions.
Well, Edward, I want to be respectful of the time you gave us. Thank you. And, John and I are easily findable on our website. We appreciate being sponsors of your club, and certainly any of the members that need help or, no cost, no obligation consultation. We are happy to brainstorm with you on your unique circumstance and situation.
By the way, how about a plug for the management development program? Highly recommend. Loved it.
Yeah, John participated a few years ago and did a great job. So good. Well, we certainly appreciate your sponsorship, and also kind of more importantly, appreciate you taking the time to give us an update on what's happening in the market, because it's turned into the bloodbath you predicted, and it's going to be like that for a while. So, David, John, thank you for the time, and we appreciate that, and look forward to seeing everyone on the next webinar. Okay,
Thanks, Edward.
Thank you.
Take care, everybody.